everyone. Lauren Culp here, President and CEO at CUInsight.com, and I'm bringing you a 3 questions video interview today with a really special guest. I am super excited to have joining me Allied Solutions CEO Pete Hilger. We are going to be talking about auto lending for credit unions, the auto lending market today. Pete, thank you so much for being here.
Thank you, Lauren. It's a pleasure to be invited, and I look forward to the conversation.
There is so much going on in the world right now. Can you talk to us a little bit about the key trends and challenges in the current auto lending market and how they're really impacting credit unions?
You know, it's interesting. You think about the last couple of years, there's been so many challenges. But one thing that did remain robust for the past few years has been the used car market. And I always tell my team, you only can sell used cars so often. Eventually, they've been sold enough, and you've got to look at other markets. And I think the challenges today is that used car market is really slowing down. You're getting rid of a little bit of the inventory issues that have been out there, a little bit of the issues with the war in Ukraine, where there was a big harness factory that blew up that created even more inventory challenges. And now you have new challenges, though. Now you have a lot of new cars coming in. You're competing against the OEMs on very, very low interest rates and rebates. You lose the opportunity as a credit to cross-sell your own products and services, so that non-interest income becomes a challenge. And the other thing is you have the UAW strike. So you have all of those, but the biggest one is the interest rate factor. As you think about the average cost of a car payment now, so that's really inhibiting the affordability of the car. Extending terms maybe be the answer, but we're pretty extended already. Buying deeper, taking more risk might be part of the answer. But that's risky today too when you look at delinquencies going up and repossessions going up. So it's a real big challenge. Credit unions are extremely resilient though, and they'll come out with a way to end up on top.
What would you say credit unions should really do to remain competitive in today's auto lending market? It seems like there are more lenders than ever before. So what should credit unions do to stay competitive?
Well, one big thing is a good blend of both direct and indirect, because one of the things you don't want to do is get into that interest rate war. We've seen what happens with the rising interest rates at unprecedented rate rises by the feds. It's been quite astonishing to watch, and they will come down. But I think what they really need to do is get a good blend, preserve your point of sale income, your non-interest fee income, and really work with a real niche that you need to be in, whether it be a certain brand like a Tesla, for example. I know Origins is working with a bunch of credit unions on developing a Tesla program, or your own local communities, and then do this marketing. You heard me talk about it during my speech. Build a robust marketing strategy. Use your outsource resources because you can't afford to do it yourself. And you have this one great thing. It's called trust. Your members trust you. You stay out of the newspapers. So I think there's a good strategy there.
I like it. You talked a little bit earlier about risk and maybe credit unions, well, should they take on more risk or a little less risk? But how do you think credit unions really should go about balancing risk and profitability in their auto lending portfolios, especially in what we know has been such a volatile economic environment?
Well, and also add to that the new CECL requirements that came into play. So you have to be a little more careful on the risk that you're taking because now you have to account for it on a monthly basis. So a little bigger challenge there. A blend of risk is good. There's some weird things going on in the industry right now. So I would say the credit score isn't necessarily the way just to measure risk alone, because there are institutions today that will actually lend to an individual buying a new car that they know has a car loan with another institution. It's called ghosting. And they will discount the impact that car at that other institution has to their credit score or their credit rating because they think they're going to buy the one that they have more equity in or at least less upside down in with the new institution. So that's one thing. And I believe that there's a lot of good risk mitigators out there. So you have, open lending as an example has default coverage on their loans. You can mitigate your risk by providing different coverages and products and services out there. So really look at the way that you can help the member. Always consider consumer value. I think that's a huge advantage the credit market has. And I think if they do that, they'll stay afloat until things turn around a little bit. Because when the interest rates drop, I think that's the time that the credits are really going to shine and have some great growth out there.
And do you think non-interest income has a role to play in that as well?
Oh, it has to. And the reason why it does two things. From a compliance and a regulatory standpoint, if the institution, the credit union, understands what they're financing, they can control the consumer value. The consumer in a credit union's world, when they're selling their products, are getting a better deal. And it's mitigating risk. It's sometimes there's products out there that protect equity. If you lose your job, there's involuntary unemployment, there's a traditional gap, there's mechanical breakdown. So not only does it generate revenue for the institution that then allows them to offer a better interest rate to their member, but it also provides the member with very good valued product to mitigate the risk that's out there when they have repairs, total losses, things of that nature.
Well, Pete, there's so much good information that you've shared today for our audience about the auto lending market for credit unions, which we know has really been the bread and butter of the industry for a long, long time. As we wrap up the conversation, do you have any final thoughts for our audience or final asks of our listeners today?
I'll kind of rehash a little bit what I shared with them during my speech at the NAFQ conference. Be innovative, pick good partners. One of the things I do when I talk to people on is I don't just promote Allied. There's True State, Southwest Business, State National. All of them have great partners that they've leveraged. You can't afford to do it on your own when you're talking about marketing and directionally marketing with digital. So don't be afraid of good partners. Do your due diligence on those partners. I think that's equally key because you're protecting your brand and your members then. But that'd probably be my biggest advice to the industry.
Absolutely. Well, Allied Solutions, speaking of great partners, we're going to link to their contact information over there. So anybody who's interested can get in touch right from the post here. Pete, thank you so much for sharing all of this great information today. It has been a pleasure, and we look forward to hopefully seeing you again soon.
Thank you very much. Have a great day.
Awesome. And thanks to all of our listeners for tuning into our 3 Questions video interview series. We will be back again next time.